Hey everybody, Jay Young here, the Jay Young Show, and it's a really good time. We're going to talk about alternative investments right now. I mean, there's a lot of insecurity. There's a lot of things going on in the markets. A lot of uncertainty. I would assume with the markets, oil markets, equity markets, and so we want to talk about that a little bit. I mean, it's this. I mean, hey man, what's going on, and how can we help? So first of all, I want to bring on Jordan Soto. Hey, my co-host. Jordan, how are you doing today?
Well, just like you were saying, Jay, my stocks are not very happy right now. But my crypto's doing okay. But
There you
yeah,
go.
no, I think today is going to be a really great conversation, especially with alternative investments, and of course getting your insight on what your company is having to offer as well.
Yeah, oh, that's great. I'll tell you what, it is. It's all about alternative investments right now, and the uncertainty
Yeah,
and not having all your eggs in one basket. But I want to
that
talk
is
about
why.
TJ Rossi here.
Diversification.
Yeah,
Yeah, diversification is
diversification.
everything.
Man, we got it all. We're lining this thing out. TJ Rossi, come on in. Tell us a little bit about yourself. Now he lives in California. Don't feel sorry for him. He's right there in between L.A. and San Diego. Which the only time I made that drive, I thought, man, I'm going to make this drive, and I did. And I got into
4 days.
LAX, and it was at night. I know, I know. It's like what a beautiful drive down, but I can't see it at night. And I got there, my flight was delayed, and I thought, nope. My wife's like, why don't you just fly into San Diego? And I said, nope, I'm going to go to LAX. I'm going to make that drive down, and I did, and it was nighttime by the time I made it. Couldn't see anything, but anyway. TJ Rossi, welcome to the show.
Thanks for having me. It's good to see you, Jay and Jordan. Thanks very much. I appreciate it. I'm a super happy investor with King, and it's great to meet some of the more people behind it. And I'm glad you had me on. So thank you.
Absolutely. Hey, well, we appreciate you, and I mean, we've got a lot of experience here at King Operating, and we do want to talk about alternative investments, especially when you have the markets going on right now. And the big thing about the stock market is don't sell. If you sold, you lost. But if you stayed in, I know your value's down. Mine is too. I'm scared to. I'm not even going to turn on my computer to see what my deal.
No,
I'm not even
I'll
going to
tell you
look.
right now, Jay, don't do it. Don't do
I know
it.
exactly. But you know what they said today, which is really interesting, is or this morning when I looked at it, and they said that the S&P is at an 11-month low or something. And I'm like, okay, well that means 11 months ago it was where it is today. So it's not like the end of the world. It's not in the end of the world. And then I text my broker and I said, hey, at 10 a.m. this morning, you watch this. 10 a.m. this morning, it's going to come all the way back, and it did not do that. But that was my guess. It was a few hours ago, and that was stock transaction. WAG for wild guess was made
Yep.
at 8 o'clock this morning, which it didn't pan out, but it's not as bad as it could have been. But anyway, we're not here to talk about the stock market or anything else. We're here to talk about alternative investments and TJ Rossi. Ross, you got involved. You got involved with us. Hey, I got to ask you. I think you and your dad both looked at our investment portfolio and decided to protect. Now you're in Fund 3. Is that correct?
Yes.
Okay, you're in
The
Fund
latest
3.
fund.
What
Yes.
attracted you? What attracted you um, to us?
It was frankly the different business model that you, Jay, actually created. We were talking about it earlier, where instead of just drilling it here and there, hodgepodge, hoping a well works, one well at a time with investor money instead, taking the approach of I kind of liken it to a real estate development, which is part of my past, commercial real estate,
Mm-hmm.
where you've got let's say you've got a raw piece of land and it's in a viable area for retail and office and otherwise. You can actually develop, parcel it out, and develop and operate some of it, or I'm sorry, own and operate some of it. You can lease some of it, or you can sell some of it once you've proven up the asset or the location. And in your case with the oil, same thing where you're buying an area that you know is going to produce after you've done all your research, and you'll have it produced for you, and throw some revenue and pay you back. and then there's gravy by having other areas or other checkerboard parcels akin to it that abut it that you haven't drilled, but you pruned it up, and you can go ahead and say, hey, look, this has resources, because you don't want to develop or drill everything at once, because obviously, the oil wells are a depleting asset the second you touch them, but you can sell them off and have a better, value add for your bang for your buck for your investors. So that model is what really attracted me to King Oil, and I had done some vetting on my own from some other sources that had invested with you guys prior.
Mm-hmm.
And again, another thing for me is your company transparency, and your communication with your investors is off the charts. Amazing. A lot of companies don't do that.
Off the charts. Off the charts, meaning that's good or bad, or is that mean
in
like,
a good way?
You can't find us?
Let me clarify that, right?
Oh, okay. I just
Yeah.
want to make sure.
It's just amazing. I mean, just yeah.
Jay's like, who do I need to get back in shape so we can meet our company goals?
That's right. That's right. So yeah, it's just the 2-minute drill, the weekly 2-minute drill, the way you guys keep in constant contact with us, letting us know what's going on, good and bad.
Yeah.
And just even being extra generous with the monthly passive income, it's great. And not only that, but the tax benefit of investing. And the year I got in did me a lot of good, because it lowered my basis considerably in the investment, and that's just leverages my return.
Yeah.
So I'm happy with that too. So it's the whole thing. And then I got comfortable once I had this wonderful book here. That
hey, there you go, man.
They actually even signed for me.
And everything.
See that now, but,
oh, that's awesome.
So just going through that was another good thing. And so I invested and wanted to be involved. And as you said earlier, I did get my father involved as well. I said, hey, Pop, these guys are great. Let's give it a shot. And we're both happy. So that's your answer.
That's great. That's great. Well, I'll tell you what, I'm very passionate about what I do, and I'm very passionate about investors' returns. And I can't do anything about the tax benefits. I mean, that's the government there. Surprisingly, the government does do something right. Just kidding. But just saying that they do the tax benefits, but if we can control everything else from the type of projects that we're drilling compared to what we do with them, how we do them, and our model. And that's the reason why I wrote the book, and it's a bestseller on Amazon or whatever. We just hit a #1 gold seal last week, I believe, on that. So yay,
really?
That's good. That's awesome.
Right.
And we're going to come out with a second edition. There's some things I need to update in the book, and instead of writing a brand new book, I think I'll put a second edition together, because there is some things that we do need to update and things that we learned. But I just love the idea of how to put these projects together and to put this together for investors, retail investors. They don't have a shot. I mean, there's nobody else doing what we do in regards to how we take your money and we invest it, we put it together, we invest it this year, and then next year we go back and put that together we're not going to borrow, 80% or 120% of your money. We may have a loan ratio like 30-40%, but it's something that we keep it active and keep drilling wells inside the partnership, so you can increase the value, so you can sell for a multiple, and that's what our goal is. So we put it together, and I tell you, I'd love to say that I'm the brainchild, but I kind of just listen to a lot of people. I was a part owner in the Texas Rangers baseball, and I was around a lot of smart people there, which I'm very thankful for, and private equity guys like Ken Hurst, Billy Quinn. Those guys are brilliant, and I learned a lot from them. A lot of guys in the oil and gas business, with Bob Simpson or Ray Davis, those kind of guys. I just learned a lot from different people and kind of put it all into one project and said, okay, this is what you need to do to get a good multiple for investors. So we put it together, and I'm just very thrilled that we put it together, and I'm thrilled that Jordan's here. Jordan, what's going on with you, and tell us what's on your mind today?
Well, actually, I was wanting to ask TJ a little bit more about the commercial real estate and private equity world that you're in, and you've established yourself as quite the leader in that space. I'm very interested in continuing to dive into real estate investments and eventually get to the commercial real estate world. Tell me a little bit more about you and your path and journey towards getting established in that space and then establishing yourself as a leader in that space.
Yeah, thank you. Well, it's actually been a while since I've done actual real estate development projects directly. That was the second uh, foray I had after grad school, and we were doing projects in what was then the growing eastern counties of California.
Oh, okay.
So growth was growing that way, which I'm pointing to the east. I am, um, and so we would do smaller sized projects. So we'd maybe find 5 to 10 acre raw pieces of land, preferably commercial corners.
Mm.
And then we would do gasoline and food pads, strip retail, office, and then the out parcels would be automotive service and care. But they would not be big box or grocery anchored. We stayed away from those larger, so more of a neighborhood community center. And we've done a couple of those. One actually here in Orange County, just up the road from me, by the way. And that model seemed to work pretty well for a while, humming along. This is 2004, and I did a certain number of 5 or 6 different projects like that. Then the GFC came along, the Great Financial Crisis, right?
Hmm.
And that really made us think and shift, because something of that magnitude had not happened for decades. You'd had recessions, you'd had setbacks in the economies over the last 40 since World War II, since the Great Depression, I guess, but nothing that large. It was just enormous, and we were in the commercial space. Luckily, there's enough insulation, asset wise and property wise, didn't kill us, but it did make us have to shift.
Right.
And so you have to make a decision: do I want to carry this land? Do I want to hold it, develop it? What's happening? Where are we? And so having some success and then having that happen was a good way for me to learn, especially as a younger guy, 20 years ago, some of the ups and very much so downs of that. So in answer to your question, it can be a wild ride, especially nowadays where business cycles are been so much more shortened because of all the artificial. I want to use the word interference from third party governments,
Mm-hmm.
the Fed and the government. So you have to kind of bob and weave a little bit more, I think, than you had to in years prior when there's much more of a free market, I think. So in your case, but the bottom line is for you, if you're interested enough, you'll do well in it, because if you want to do it, you'll do it, and you'll just find a way. And so from there, coming around back to real estate, um, not so much involved directly in projects, but on the investment side now. So now I invest as a limited partner or directly in commercial projects. And even in this case with King Oil, it's not real estate per se. It's the oil as a commodity, but we are buying leaseholds. So in a way, it's investing in private property, oil there. So it's just, if you have your passion and you like it and you love it and you're interested,
Mm-hmm.
that's what will get you to it.
Yeah.
What were you thinking about getting into?
Yeah.
Well, to be honest, I really have been wanting. I don't know when, but I really would love to have like a boutique hotel that has up to like 20-ish rooms. I don't know if you've ever been to Denver, but there's this awesome place called the Ramble. In Houston, there's this place called Colum Dior. And so they have up to, 26-ish rooms or so, and it's a boutique style. And I like the intimacy of that, but I like the artistic statements that those places have made as well. So I really love like interior design and investing in those projects. And I think that it gives people an experience, which I like. It's not like the real estate tyrantness that I'm into. It's more of like bringing an idea to life in a way that impacts people and their experiences, and offers something that really resonates with them more. But I'm able to do that through real estate. And for context, I did this with Airbnb with 2 units, 2 studio units, which are basically like hotel rooms. So very small scale, but ran it very well and increased profit margins quite drastically from start to my buyout. I like that space a lot, and I hope that answers your questions. And
Yeah, that's great. It's funny you say talk about that Airbnb, because if everybody remembers Airbnb when they first came out, it's awesome, it's great, it's still okay, but the pricing was better. You have
yes,
much more variety, and
it
then it
wasn't
kind of
saturated. It wasn't as saturated either. And
saturation.
now
The,
it's
the
quite
cities weren't
saturated.
having a problem with them yet, and they were good. And then I think it's shifting back more towards the hospitality sector. Hospitality is shifting back more towards the hotel sector now,
Yes.
because the pricing has leveled out compared to Airbnb generally on the whole, and and even better in some cases. And in lots of cases, you're actually getting more for your buck.
Yes.
You're not having to clean up. You're not having to overpay for a cleaning fee. So the hotel, and you have all the amenities, right?
Yes.
And in your case, if you do something like that, that's got a unique image or brand to it, it's yours. It's kind of a neat place. That could be pretty good. So it could be a pretty good niche. So I think with the hospitality landscape shifting mostly more towards back hotels themselves and boutique, could be a
Yeah.
good thing.
Mm-hmm.
Yeah.
Yeah.
Well, I'm working on a business proposal for a specific area in Houston that I'd like to buy and build up. So I'll be giving you a call.
Hey, all right.
You and Jay. I'll
That's what it's
present
all
it. You
about.
guys just tear me to shreds with the first ever business plan, but that's how you
No,
learn.
absolutely.
Hey, I would. Go ahead, Jay.
I just said I've told Jordan a lot. Hey, you got to try it. You got to throw it out there, and you got to put it up there and see what happens. And if nothing happens, and you made a mistake, and shift it and move on. I mean, that's one thing that I've talked to a lot of people, and I've mentored quite a few. And I said, you know what? I said, dude, you just don't have it. And they go, what do you mean? I go, you don't, unless you change up your attitude on, trying everything, and if it doesn't work, you don't quit. I mean, it's like you don't take an excuse that somebody gives you that doesn't matter and decide, oh, I'm not going to do that anymore. I'm just going to quit. You can't do that. You got to be resilient. Resiliency is part of the number one word in an entrepreneur's life, and trying to figure out exactly, oh, what do I got to do? It's like, no, I want to make $1 billion. I want to make $1 million. I want to make whatever it is, and just mapping out a plan on what you need to do and going after it, and not taking no for an answer.
It's like being a quarterback getting knocked down a lot. You got to have a short memory.
Yeah.
You got to remember. So it can be very tough, as you know, Jay, and Jordan, as you know, with your own forays. But unless you try, you don't know. And nothing venture, nothing gain. I know it's cliche,
Yeah.
but it is true. I've had completely my fair share of setbacks. Gotten whacked a bunch of times, professionally, financially, and that's how you learn. Literally, you can't learn any better than having things not go your way. Seriously,
Yeah.
it's the best teacher.
Yeah.
And so to get knocked over by it and stop doesn't work. I mean, it's natural to want to at that moment, but then you try again, and the more you keep going, the more you can keep going, the better it gets. And so at some point, the law of averages should kick in, and you can win.
Right.
And like one famous investor once said, you only have to win once.
That's true. Absolutely. Once in a big scale, in a big scaling event that you've oversaw that worked well for you. I agree with that. I mean, it's like resiliency, and you have to have the type of person that won't give up, and then after that, you have to have the product, that says, okay, this is it. And sometimes that product isn't the right one at that one particular time, and you have to try it over and over and over again to make sure it's the right deal. But it's like these guys that are multi-billion. I'm thinking about John Goff, who his house was filmed in the movie Landman, and we had dinner with him the night before Landman started. But anyway, he started the buoy, but he's had so many different, in commercial real estate, he's made so many different acquisitions and sold, and then all of a sudden he bought it back for pennies on the dollar. He's made a tremendous amount of money, but his buoy would be something that I think that you would be interested in, Jordan. That type of boutique hotel that pop up everywhere. They're really nice, and and intimate, and making sure that that's what that's your vehicle, right? You have to have the person, the vehicle, and the money, and you have the person and you have the personality, and you just got to find the right vehicle, and then you got to go find the money. Find the money.
Yes,
You
I
gotta,
think that's what everybody's after. Getting started is it's always one of those it feels quite daunting and then you're like, okay, well I have this thing that I've kind of started, but how do I like really establish myself and how do I continue forward? TJ, when you're looking at yourself in your career early on, what challenges, because you mentioned that you had a few challenges that you had to overcome. So what specifically are you referring to, if you don't mind sharing with us?
so one of my favorite Shakespearean quotes that I learned the hard way is expectation is the root of all heartache.
Mm.
So I learned to expect the unexpected because all we tend to see are these successes. We tend to only hear about these successes. You only see the building that went up. You only hear about the stock that someone sold for
Right.
30x return.
Hmm.
You only hear about people who win the lottery, not who lose it. So I was a bit naive in my younger years, thinking, well, I just have to work hard. All I do is work hard and follow the rules,
Right.
and and it'll happen this way. All these people, all these nice houses around me. That's all they did. They just followed the rules and worked hard.
Mm.
No. So what happens is life is not that way, which I had to learn. So you learn to expect the unexpected, and when things do go wrong, you're not going to be as affected, and you're able to have the resilience that Jay is talking about to keep going forward. And there would be micro setbacks. Let's go back to the real estate days with a project getting delayed, a city denying request, overruns, that kind of thing. Fine. Then you have a macro, which is the great financial crisis, which I just talked about, and you have to adapt and adjust. And to answer your question, going through some of those, and that's only going to come with years. You're not going to get it in school. There's no book you read. Nobody taps you on the shoulder and whispers in your ear. It just kind of goes along with moving along in life that way, right? So I would say expect the unexpected, and know that that's going to be part of the deal, and not to be afraid of it, rather embrace it, because it is going to teach you something that you'll probably not do next time, and hopefully do better. So that's one thing I would say for getting into your run there for sure.
Yeah. And I think
Have to
making
work
sure
on
that
that.
you don't I think making sure that you don't make the same mistake over and over and over again and expect different results. It's like I think that's one of my biggest challenges, is and not knowing what you don't know, or you don't know what you don't know type. It's like, okay, and when the oil and gas business and in business for as long as we were, and trying to make it to where, what, hey, we put together projects, and we may invest in a one well deal. Well, the chances are really good that you won't even get your money back on the deal, just based on oil and gas and how it's all put together. And so how can you do it better? And I wish I'd have thought this up, 30 years ago, or 40. Well, let's not go back that far, but maybe 30 years ago or something, and just said, hey, you know what, we should have done it like this, and you put this together, but I wish I'd have done it a lot more. Learn faster, and act faster. It's like learn a good
Mm.
trade. That's why my buddy told me, I went to work with him when I was a stockbroker, and he's like, you need to go work for a bigger company. I'm working by myself. He was trading stocks on the New York Stock Exchange for French institutions. He was from France, and I met his sister at a Series 7 school, and he said, Jay, I got an office for you, but don't come to work here, because I can't teach you. You need to go learn somewhere, 2 to 5 years, learn something, learn a trade of how you can make money. How can you make money at this and be successful? And so I worked for him for about a year, and then I went off, and after I lost all my money, didn't have any more money. I'm like, oh, okay, maybe he was right. And so Louis Clamore, World Market Equities in New York. But anyway, I still talk to him today. But in 1990, I decided, okay, I'm gonna go to work for. I'm sorry, 1988, I went to work for another company for a couple of years. But I think that's really smart. Is he told me, he said, go to work for somebody else for 2 to 5 years, learn it, and then after you learn it, then you can start off on your own. So I did, and went over to work for another company, and then went to another company. But then 30 years ago, I started my own company. But I think the biggest thing there was learn fast, learn what works faster. And if you're at a place that the people around you are making a ton of money, that's awesome, right? It's like, good. Okay, how are they doing it? And if you want to go start your own company, or if you want to, whatever, then fine. But be around successful people and learn
I just
early.
think with, I'm sorry, Jay, I was going to say with your business, I mean, you obviously tell me, but it's got to be so difficult on so many levels. You've been able to navigate this with your own shop there for 30 years with your awesome team. Not only do you have the risk of drilling and something may not produce, may not work out, it may be dry, it may be, just bad. You've got that, but also you got the volatility of oil prices.
Mm-hmm.
And with oil prices, you never know what they're going to be. They've got to be within a certain range to, make sense to, deploy more capital to projects. So, like, how have you been able to navigate that so well for so long, with all these moving parts and different aspects that are coming at you at all times, whereas other businesses can be a lot more easily planned out? So, what's the best strategy, you guys, or what's your best tactic you've used to be able to navigate that so well?
Well, yeah, it's a good question, and I appreciate that, because years ago we didn't really navigate risk because we're like, okay, we'll go drill a well and see if it produces. Today's world is a lot different because we're inside a fund, and it's like Exxon. They got 40 rigs running right now. They don't hit any dry holes. So what we're trying to do is try to do the same thing that they do in finding prospects and paying for them, paying for projects that you got to pay for acreage. You got to pay to play, be in the right area, which is what we're doing on the Bivens Ranch. I mean, there's been Apache drilled 18 wells out there. They hit every one of them. So you're going to produce oil and gas where we're drilling. So you don't want to go take huge risk and be away from it. You want to be right in the middle of where we want to drill, right in the middle of where we are, and you want to hit, you want to produce. And that's what the big thing on us is you can't do what you need to do in this industry, and you can't do what we need to do if you're drilling risky projects. And we've done that before. We've done that, and that's not good, right? You don't want to do that. So you want to mitigate as much risk as possible, and how you do that is by drilling wells in areas that have already been produced, a lot of production around us. Like in Hockley, we're drilling right in between two huge oil fields. We're drilling offset wells in East Texas, Eastern Shelf of the Permian. In Bivens, we're drilling wells that are literally 18 Apache wells, and we're drilling offsets there. So you drill wells in a good area. Now that's the first thing. The second thing is that oil and gas prices, right? You said something about that, and fourth generation. So I've seen a lot of ups and downs. 1986, 2015. I mean, there's been a number of ups and downs, and I haven't counted them all yet. Somebody did the other day. They said, I've been into like 5 or 6, 20% swings of the oil and gas markets, and they've been in it 30 years or so. So I guess that's a big swing.
Yeah.
In a commodity, and especially when you're doing it like we are. But the good thing about the way we navigate our projects is we raise the equity first, and then we bring on some debt, and we only bring on 30, 40%. But we're also going to increase the value with that debt. We're not drilling wells that are risky. And I think that's the key. That is the key to our project compared to other oil and gas companies out there. Other oil and gas companies, well, two things. Number one is you drill wells inside a partnership, and if you have, let's say you raise $100 million, you go drill 10 wells inside a partnership. That's it. You drill the 10 wells, and that's it. You receive income for as long as those wells produce, and when they quit, that's it, done. End of story. But what we do is use that as collateral year 2, and then use that as collateral to go drill more wells. So we're increasing value. Nobody else does that. So that's something that we have not perfected 100% yet, but we're doing our best in good areas to show, hey, this is where we're drilling. This is where we use that as collateral, get that credit facility, so forth. So we're on our way to a really great track record that nobody else is doing. So we're going to be like the disruptor.
Another thing that I think you've mentioned many other times is like how the industry is ROR and return on relationships. And I think that having the right partnerships is also really crucial to your success when you're looking at building your empire, as you will. So a little bit of a offshoot from what you're talking about there, Jay. But TJ, I'm intrigued because we've like Jay and we've talked a lot about like his approach to business and his investment style and the types of places that he's drilling at and taking investors' money. And while investors are not necessarily, I don't know that you would deem an investor as a partner, but I think that there is this partnership like approach there. But when you're looking at your role in your career and the business ventures you've gone into, what are you looking for in partnerships? Maybe what are you looking for in investors as you partner with other people to invest in projects and things like that? Again, I know that it's slightly off of what Jay is talking about here, but I do think that that's also a key part of growing your business is partnerships.
So I would agree with you 1,000%. And without the right partners, and again, it's going to sound cliche, but it's absolutely true. They are either a dream or a nightmare. And I've had both. And
I think Jay's had both too.
Oh my gosh.
They're either a dreamer, seriously.
Yeah.
And it's part of the learning process, part of the learning curve. You're not psychic. You do your best to vet up front, and it'll be different. For example, I would consider myself to be a partner with King Oil, but I'm not a direct partner internally, intimately, but as an investor I am. But I do consider King to be a partner with me in how I wanted more exposure to the oil world. Okay.
Right.
So I vetted the heck out of King in many ways. I have ways of doing it. I did before I jumped in, before I invested a single penny. So
let's talk a little bit about that, because that's intriguing to me, because I'm like, I want to invest and diversify my portfolio, but if I'm a little skittish at first of like diving in deep, investing lots of money, what did that look like for you?
So there's
if you can share, I don't know if you can share, but if you can.
I don't have any secret sauce to hide from anybody. So really what I do, I'll speak for myself, I tend to research something intimately before I get into it. And then I will myself, other portfolio managers would tell you that I'm over allocating, but I get more aggressive with each position I get into because I've studied the heck out of it and I'm going to be in it for a while. So what I do is just by way of my again, it comes back to interest. We talked to interest a few minutes ago, right? I'm interested. I like to learn about different ways to put money to work. And I like the challenge. I like the intellectual challenge. I like to learn about it. What's this? Where would it fit in my portfolio? How will it diversify? How will I be decorrelated from the public markets? How will I have things, decorrelate from each other, all the assets, in the best way I can? Because I want to be as up and to the left on the risk reward axis as I can, right?
Yeah. Mm-hmm.
And so what I do is I'll always look at it intimately. It'll take minimum weeks, usually months, sometimes years. And I have to really, really know it, almost like I know it as a person, and watch it, learn it, study it before I get into it. It might be something I've never heard of before. Like recently, I got into what are called catastrophe bonds. They're part of what's called, there's an insurance-linked securities are part of the investment world. There's different things you can get into, one of which are catastrophe bonds. And I'd first heard of these things, like, what the heck's a catastrophe bond? And I was so intrigued. I just wanted to know what it was, first of all. And then I just researched it and listened and learned and heard all kinds of viewpoints from different areas, so I can get multi perspectives. And then I decided, okay, I'm going to give this thing a shot. And to get back to your question, Jordan, where you asked about diving in, I may be confident in it and I'm going to over allocate on my own, but I will start off, let's say I want to put X amount in at some point. I'll start off with Y amount in the beginning to watch it. And trust me, when you have your own money actually live ammo working for you, you're watching it that much more closely. Okay.
Absolutely.
Yeah.
Absolutely.
Nothing will teach you more than mistakes, and also your money's live. It's not just a pretend portfolio. I can, glance. It's real. So
Yeah.
that would be what I would suggest to start off with. You're interested, you research it, you get into it. Start off a little bit small, see how it acts, see what it does, and take a few licks if you have to. And if you don't like it, get out. If you do like it, put some more in and see how it goes, and then just repeat the process. So that's what I do for my own self with any different position I ever get into. And I'll put a larger amount to that position than another manager might, but I've researched enough that I'm comfortable doing so. So
Right.
that may
Well,
work
and
for
you
you.
intimately know the product and the
Mm-hmm.
service and the offering and the output. So, or the projected output.
Yeah.
Because you've done the research and you understand. So, that is interesting, and I feel like what an alternative investment to have catastrophe bonds. I didn't know that that was a thing.
Yeah.
I'm sure a part of your research had many conspiracy theorists on it.
Yeah.
I because my mind's like,
It's
these
yeah. It's yeah.
flyers, and if
That's the
you,
fun part of it. You get to see these cool things you never knew existed.
Yeah.
yeah,
And then you try to get as make the most asymmetric positioning or bets I hate to use the word bets, but asymmetric investments you can, with the
right,
asymmetry being you're going to have a higher upside than possible downside if you can help it. It sounds obvious, but that's part of the trick. Another challenge is not just diversification or over diversifying.
oh, interesting,
That can happen too, but really what's a big challenge that people forget about is position sizing. So we
okay,
talked about it getting into a position to start off to learn it, but another aspect is the actual eventual size of it,
mm,
because that can be a killer as well. You can be a little bit right, but a lot wrong,
Mm-hmm.
and
mm,
vice versa, for that reason. So you got to kind of manage that also. So that's one thing I would suggest also is just to learn the sizing, not just entry, but eventual.
and when you're making those decisions to adjust your investment, um, uh, the amount of your investment with a specific product, how do you determine that line of like, all right, nope, this is a no for me now, or okay, this is a yes for me? Is it not just noting the potential, but recognizing the patterns of the product and its output, or is it a gut feeling? Is it a logical feeling, or a logical note? Like because I'm very gut based. I'm like, no, I have a feeling. I go forward with my gut and I'm very firm about it. And it usually works out. There are times, obviously, where it doesn't. But for you and Jay, I also want to know your opinion. And I think we've talked about this before, but TJ, we'll start with you. When you're looking at that, is it gut or is it logic that leads you into doing more or taking a step back?
Yes.
Yeah. Oh, it's a yes.
The answer
Okay.
is yes. It's both. It's both. It's both. It's the logic, it's the assessment, and your feel. But
Mhm.
a really big way, a big um, tool that I use is if I become over or underweight in a specific position or sector or or where I want to be. So what I do is for the entire investable assets, it'll be partitioned into certain percentages. Some real estate, some corporate debt,
Mhm.
some distressed debt. It might be some precious metals. There's different areas within the portfolio that if I see something getting over allocated, let's say something's doing very well. So for
Right.
example, I did a lot of private equity. Uh, I started off with a lot of private equity about 6, 7 years ago, and over those years, a lot of them have ended up doing very, very well. So I was extremely overweight all of a sudden, and
Mm.
luckily a couple of exits happened, so I was able to cash out and then reduce that exposure in my portfolio of private equity itself and go into other areas and diversify. Because with some of these investments, with the illiquid nature of them,
Mm-hmm.
you can't always do that. So if you're, let's say, for example, right now, if I'm overweighted in private equity again, then I have to watch, even if the most awesome opportunity comes up, I have to kind of remember this looks great, but I'm going to, break my own rules here of not being over allocated to avoid concentration. So there's diversification risk and there's concentration risk, right? So to answer your question, yes, I was joking, but I'm serious. It's the logic, but also the feel.
Yeah.
And if you just kind of get a sense for it. I'm sure you did the same thing you just said. And Jay, I'm assuming you've been doing this as an entrepreneur, business owner for so long, an investor yourself. I'm sure you're the same way. You probably employ both. I would assume.
Yeah. And I was going to say something about that because normally, back in the day, we say is, it's like normally you invest, you have money that you take out of your company, you put it in your stock brokerage account, Charles Schwab or Merrill Lynch, whoever, and you invest there, but it's all in the stock market. So it's like every bit of your savings is tied into the stock market, and that's going away now compared to what it was years and years ago, because that's all we knew back in the 80s, 90s.
Right.
I
don't want to date myself too much, but but in the
just
80s,
means you're experienced.
Yeah.
Yeah, exactly.
Experience. There you go. And
you're just wise, Jay.
Yeah.
Just really wise.
Hey, thank you. But it's kind of like, but that's right. And we didn't have any alternative investments. And so in today's world, it's like, and unfortunately, people need to put money in the oil and gas business. Now, I don't think that everybody needs to invest in oil and gas I don't know what size of their portfolio they need in oil and gas. I think they need to invest with me or somebody like me that's done the research and that cares and that has a good vehicle to make money. And I don't say that all our deals are going to work out 100%, but my deals are going to work out 10 times better than any of the other places on the market that do business the way they do. And I'm not saying that in a bad way. Well, I guess I am, but those guys are a bunch of whatever, but they just don't know the difference. And I did too.
Well, Jay, when you're looking at the, because something that's kind of like popping into my head right now is oversaturation, and we've talked a little bit about that. When you're looking at people that you're the investors that are coming into your funds, is there a specific cap for that so that it doesn't get oversaturated, or is that something where you're just like, okay, we're going to take as much investors as are wanting to invest in this, and then split the profits that way? What does that look like for you?
Yeah, I mean, we just raise a fund and say, okay, we're going to raise $100 million or $125 million in a fund, and then the investors are accredited. They're all accredited, and we like to talk to them and find out, hey, are you, but normally they're not going to overinvest. If they're accredited, I mean, they're worth $1 million or more, so they're not going to put in. If they're putting in 500,000 or something major, then we make sure we talk to them and say, hey, what's your portfolio? What are you working with? And we'll make sure that you're not, because this is a risky investment. No matter, I could be the best guy in the world. We could go drill the best wells in America. And all of a sudden, if oil prices go to $20, I mean, it's like, oh my goodness. Well, we don't sell at that point. We're not going to do like the stock market. Don't sell in the stock market the last 2-3 days here with your tariffs and all that. But don't sell, but just hang on. We'll come back and we'll be resilient about your investment returns, but don't expect don't expect something that could be risky, or it could be your dividends may go up and down based on oil and gas prices, which is what we feel like is the biggest risk. Which is good for us is it's not the company or the people that work here who have a great staff, or it's the vehicle. We're drilling in great areas, but it's the commodity risk, and that's good for somebody like TJ that's done their due diligence. And I did not want to make this about Jay Young and King Operating and things of that nature, but you're making me. And if you're going to ask me, about me, man, I'm an open book, and I'm gonna toot my horn and pound my chest and all that.
Hey,
because
you're doing it, but I think you're doing it in a humble way, and I think everybody really appreciates that. I know that we're coming up on the end of our time here today, but TJ, I have a couple more questions for you. Sure. Jay, do you have
Well, I
some
wanted to ask.
questions?
I know before your magic question, Jordan. Which, hey, yeah, I love the Jordan final questions. And even if she's not here, if she's busy or traveling, I even ask them
You
for
always
her.
ask
So
it though. It's
I
great. It's
do, I
great.
do. But anyway, TJ, I want to know what your thoughts are. Or what if you're saying oil and gas as an investment in a portfolio? I want to ask like what percentage. No, I don't know if I want to ask that or not. You're not an advisor, so you really can't go there. What other investment alternative investments out there are attractive in today's market? Maybe I should
There's
ask
a
you that.
well, yeah, and there's to me they're attractive in any market. So if you've got a situation where markets are up and down, which they're always going to be, or things are more risky, they're attractive in any market to me. So in my case, I'm big on really interesting things, such as at the moment, I'm involved in a bunch of funds that are invested heavily in the equity tranches of collateralized loan obligations. And what that basically means is that I basically in a fund that owns these loans, these commercial loans. They're broadly syndicated loans, BSLs. And people would say, "Oh my gosh, why are you doing that? There's this horrible recession that we're already in, or it's coming, and it's a bad deal. And why would you do that? Why would you be doing that? Commercial real estate is going to have some trouble, and a lot of these medium-sized banks are going to get hurt even more if these things go belly up." And so what I do is I stay in those regardless because I believe in them on a fundamental level. And I don't want to sell just because something's down or get out when something's down, for example. But because that all that does is crystallize your losses,
Mm-hmm.
and I stay in them. So to answer your question, Jay, it's what I just mentioned, but also right now a lot of distressed corporate debt is something that I'm involved with, along with distressed commercial real estate. So there's a couple funds that I'm in that are uh, aiming at those,
Mm-hmm.
which there will be a lot of opportunity coming on very shortly with this year, especially with how rates have been and how they've changed. So it'll be those kinds of things. It'll be things that generally are not very liquid or publicly available or what people typically think of. And so my two favorites right now to answer your question, I guess simply would be the distressed corporate debt side and the distressed commercial real estate
Yeah.
sides of things, which are going to have some opportunities
Yeah.
along with others.
Gotcha.
Well, off of that, when you'd mentioned that you do like a research frenzy when you're looking to invest in these things, just to understand it almost like that of a person and kind of get a profile on them. Um, what would be your advice to somebody who's starting to do their due diligence for an investment? Like, what are some common mistakes that people make in their due diligence, or what do you find as like a really key um,
Yep.
due diligence factor for yourself?
The biggest one ever, if I could tell anybody. First of all, it's going to come from interest. So if you're interested, you're going to naturally want to know more about it
Right.
and start reading about it.
Absolutely.
That's the main thing. So if someone just wants to get rich quick with something and don't care about what it is or what's underneath it, it's probably not going to work. It's more like buying a lottery ticket
Hmm.
because you've got to be interested to know about it. But the biggest thing I'd recommend to anybody ever is not to forget the risk part of it. We all see the shiny object. We see the crypto returns, the
Right.
stock did this, did that. This guy developed those properties. Oh my gosh, he made so much money. It's very easy to see the risk. I'm sorry, the reward, but the risk is something that most people ignore. I tend to look at that first, and then I'll justify that risk with the reward if I can do it. If I can't, I won't do it. So remember, I want that asymmetry, and
Right.
so something has to make sense to me from a reward standpoint over and above the risk. It's just basically it's just again trying to get as up and to the left as possible on that risk reward graph,
Right.
Mm-hmm.
but to have the most efficient investment you can have. So the answer to your question would be to not forget the risk part of it. Look at the risk
Yeah.
first. Don't be afraid of it. Know what it is, and know that I'll give you an example. So if somebody sees a regular public stock and it's throwing it's yielding 35%. Well, there's maybe a reason. Yeah, it's 35 cents a great yield. That's wonderful. What's the reason? Is it what's wrong with it underneath? If there's something wrong, look at that also. Don't just buy it for that purpose. Assess it first. You might see the most beautiful property in the world, and behind it's nothing but, termites and rats, right?
Right.
So look at everything and look at the risk factor first and foremost is what I would probably say.
Well, Jay, I have one last question for TJ. Do you have any other questions that you'd like
No,
to
hey, you
ask?
go right ahead. I'm
Drum roll, please.
I mean, I'm sitting here on pins and needles. Can't wait.
Well, TJ, looking at your career and how it's evolved over time and the projects that you've managed and been involved in, what advice would you give to your 18-year-old self?
Pretty much what I answered earlier as far as expect the unexpected. I would say, again, expectation is the root of all heartache.
Mhm.
Just know that there's going to be things that you don't expect. It's not all roses. It's not all going to be easy. It's not all going to be, it's as simple as you just do these things and things will work out. They may not. You may do everything right. You may be a great guy. You may be smart. You may be hardworking, but there's going to be these things that are beyond your control, really. So understand that you're not in control of everything. Just control, work with what you can control, understand the rest of it, just kind of be ready for it. But if I could go back, that is absolutely what I would go with. I would say expect the unexpected. It's not as simple as just doing these particular steps to get to that goal. There may be some stuff outside of it. So hope maybe I can go back in time someday and do that. But for now, I'll tell my future self now at
There
70.
you go. There you
Yeah,
go.
I'm not
Hey,
70 yet, so I'll tell them that. I do have some time still, I guess.
There you go.
Right.
Absolutely. Well, TJ, it's been an absolute pleasure getting to talk with you. We look forward to catching up with you in maybe a few months or years, looking at
Yeah, I
those
love it.
future projects that you've started investing in, especially with those new bonds that you've found. It's quite intriguing to me. So
yeah.
thank you.
Well, thank you both. I appreciate it. I was honored to be on the show, and I wish you guys and all King all the best.
Hey, there
Awesome.
you go, man. I tell you what. Well, I mean, we're gonna do great here. I mean, I'm really excited about what we're doing, and our downside looks good with what we've done, and we have some really smart people here, which is awesome. But but I appreciate your confidence, and it's good to know that you did some background on us, and we passed. Obviously,
Yes.
since you're an investor and you're here, we appreciate that. So, hey, I always like hearing that because I mean I know that there's nothing that I'm concerned about in my background, and if there is, I'll tell you about it. I mean there is. Hey, I'm not perfect. I'm not saying I'm perfect, Jordan, but
I've never met anybody who is, so
yeah,
there you go.
Yeah.
man,
But I do think transparency is everything. People like it's a step past honesty because there's context involved in transparency along with the honesty, which provides a deeper understanding of what's actually going on. So
yeah,
Jay's always been really good about doing that, as you've
It's
mentioned,
great.
TJ.
yeah.
So it's nice. It's nice to be a part of a culture that's like that, transparent.
Yes, definitely, definitely. I appreciate that, and I do need to. That does remind me of something here. I need to write down to get to take care of when I get off. But anyway, everybody, thank you so much for coming in today. We have had a great time. TJ, it's been great having you on. We appreciate you and coming on, and we do want to hear more about what's going on with you later on. And Jordan, obviously, pleasure having you here. And
Yep.
I think this is one of the best ones we've ever done here. Let's learn. And I've always thought about rich people, rich oil and gas guys, and how do they get there? What do I need to do
Yes.
to get to where they are? And I think that's a good. I need some good role models like that. So I think that's good, and we want to be here and do that. And that's what the Jay Young Show is all about. It's about learning different types of industries, but making sure that you know what we've been there, done that, made some mistakes, but we're not gonna keep making them. We're gonna get up off the ground and we're gonna continue doing something that we feel great about. We feel transparent, and we can always, look up and say, hey, God, we did the right thing. So appreciate everybody here, and we'll see you next week on the Jay Young Show. Thank you.